Hi everyone, this is the second episode of the ATHX podcast. Today I'm going to be talking about the share price of Athersys, why I believe it is low, and how I believe that can easily be changed. My name is Nick, and my social media can be seen on the bottom right of the screen. This video is going to be a bit theoretical, but does relate specifically to Athersys and the share price of ATHX. As I'm making this video, the stock price is at $1.15, and the market cap is $260 million. I'm making this video in the event that positive treasury results do not bring about a reasonable share price. I'm going to be proposing a couple solutions in this video that in a perfect world wouldn't have to be employed, and I hope that this video actually becomes irrelevant. But in the event that we don't see reasonable stock price appreciation from positive treasury results, I think these proposed solutions should be considered. So before we begin, here are some disclosures. I'm not employed by Athersys, I'm not a financial advisor, this is not investment advice, and I own shares of ATHX. I want to start out by talking about stocks as a concept and why they move. Stocks are financial instruments. It is an ownership right of a company. Various market forces affect the stock price of a company, which may or may not delineate the stock price from its true value. So what are the market forces that influence the stock price? I've listed as many as I could down below, and these include intentions and incentives of the investors, risk tolerance of the investors, capital available to investors, interest rates, PR reach/publicity, perceived earnings potential, perceived risk, and a float. The top four are forces that companies cannot directly change, and the bottom four are forces that companies can directly change. So based on those described market forces, I've created an argument that may explain Athersys' stock price. The argument is, by definition, a stock is a security that represents fractional ownership of a corporation. Although a stock represents ownership of a corporation, stock price is dependent upon supply and demand for shares at any given time. Therefore, ATHX stock price may be suffering from a supply/demand problem rather than a fundamental problem with the company and its outlook. And taking this a step further, based on the research I've done on the market forces, my hypothesis is that Athersys has an excess supply of shares, more specifically an excessively high float, which inhibits significant stock price movement and actualization of a closer to reality net present value/market cap. This can easily be changed. For those that do not know, float is a number of public shares a company has available for trading on the open market. It's calculated by taking the total number of outstanding shares and subtracting the number of restricted and closely held shares, which essentially includes the shares held by employees or major shareholders. According to finviz.com, Athersys has 222 million shares outstanding, of which 207 million are floating. And you can see those numbers right down here in this area. Those numbers may be slightly higher now, but those are approximately the numbers. And over the course of this video, I'm going to try to show you guys that this float number of 207 million is not typical for pre-commercial stage biotechs or even early commercial stage biotechs, and that may be why the stock has such a hard time gaining traction. I haven't seen many people discuss float as it relates to Athersys stock price, so I would like to shed some light on it. Here is external validation that float affects stock price and volatility. When you Google search float relationship to volatility, the top result is from Investopedia and states, a stock with a small float will generally be more volatile than a stock with a large float. This is because with fewer shares available, it may be harder to find a buyer or seller. This results in larger spreads and often lower volume. When you Google search float relationship to stock price, the top results are, stock float affects a company's share price on a daily basis. It's the supply and demand. Without a limited supply of shares, it would be hard for traders and investors to determine value. For such low float stocks, a fundamental driven rally creates demand. In other words, investors are stumbling over themselves to buy shares when they are scarce, driving the price higher in dramatic fashion. The impact this has on stock prices and volatility can be dramatic. After all, it is supply and demand that dictate the prices of stocks. To that end, if more and more institutions gobble up the outstanding shares of a company, it takes less and less demand for the price to rocket higher. So here is a very clear example of the supply and demand mismatch and how that affected GameStop's stock price. To be clear, I'm not seeking a GameStop-like frenzy for Athersys, just using it as an example to prove the importance of supply and demand on a stock price. I also have some internal evidence that shows the strong relationship between float and stock price. First, in what I thought was research unrelated to Athersys, at the beginning of 2020, I started going on the stock screener finviz.com and tracking the top gaining biotech companies per day and then collecting data on how they trade. I was looking for any commonalities or patterns that could help me in trading. What I found was that the top gainers almost always have low float. I'm going to quickly show you my data set and run through the float of the top daily biotech stock gainers during this period of time. The reason I'm showing you this is to illustrate why I believe other biotech stocks move upward on much less significant news than Athersys has announced and is likely to announce soon. And yes, these stocks also fall quicker than Athersys currently, but the point is that if fundamentals are solid, which I believe they are for ATHX, then it is easier to move up with a lower float. So let's open up the data set. Before going through these, let's remember that Athersys has 207 million shares floating. With the data set, I separated the gainers by the news that caused their significant gain. So for instance, this first one was Leap Therapeutics announcing partnership and financing. Their stock went up over 50% this day. And they had 21 million shares floating, with 45% of the shares owned by institutions. The next one is Palm, and they announced a licensing deal with Johnson & Johnson, and their stock went up 86% this day. They had 20 million shares floating. And I'm not going to go through the details of all of these and all of my categories of data, but I'm just going to read the floats for this category, deal announcements, just so you get the idea. This next company, they had 3.5 million shares floating. Next company, 51 million, 69 million, 23 million, 15 million, 13.5, 6.8, 25, 4, 56, 7.3. Okay, and so among all of the data that I collected during this period of time, the floats for these range between 450,000 shares and 130 million shares outstanding. There were two outliers examples, but they were both Moderna, and that was during COVID times when Moderna went up on phase 1 vaccine data. Their stock gained significantly, so there was really high demand. They had 253 million shares outstanding. They had, significant demand because of their vaccine for COVID-19 data. Now I'm going to go back and look at 3 examples of companies that had announced positive phase 3 data that made the top daily gainer list. Take a look at how all of these charts trend upward going into phase 3 data readout. And now let's look at their float. This first company had 48 million, next 43 million, and then 42 million. Also, just yesterday, the company Cortexime announced data where they failed to meet their primary endpoint in a phase 3 Alzheimer's trial. So I think we should look at their chart. So going into the data, it was trending upward. The stock was trending upward going into this data. Obviously, it started to trend downward, going right into the readout, and then dropped 75% today due to the failed trial results. When you look at Cortexime's float, they have 20 million shares floating, and 63% of the shares were owned by institutions. You have to wonder why a similar run-up isn't happening to Athersys going into treasury results, which have a high likelihood of being positive in my view. Similarly, if you think back to 2019, when Athersys announced positive mustards trial data, the stock really didn't move very much. It moved 16% that day, if I remember correctly. And at the time, it wasn't a guarantee that the cells were going to work for that indication. Competing therapeutics were nearly non-existent, and on top of that, it validated the Masters-1 data, which is very important for the value of the company. So I'm suggesting that that muted reaction was due to having a high supply of shares or float. It makes you wonder if the same thing will happen with treasury data. I hope not, but if it does, that's why I'm making this video. Next, I'm going to illustrate just how high of a float Athersys has relative to other stocks in the stock market. According to FinViz, there are 5,469 stocks in the stock market. I've seen varying numbers on that, but that is approximately the number. 778 of those have over 200 million shares floating. Only 25 of those have less than a $1 billion market cap, and only 8 of those have a lower market cap than Athersys. So I've listed the 25 with less than a $1 billion market cap below. But what that means is that 753 of the 778 companies that have over 200 million shares floating have over a $1 billion market cap. The conclusion that I draw from this is that Athersys has an unusually high float relative to its market cap. It likely does not have enough of the other components or market forces that make up demand to counter their high supply. Here's my proposition of how to solve this problem. If we do not see reasonable and sustained price appreciation upon announcing treasury data, I'm proposing that the company performs a reverse stock split, as I believe it would resolve the low market cap problem. Doing that would result in a lower number of shares outstanding. How much lower would depend on the reverse split ratio that is decided on, but I would suggest aiming for 45 to 90 million shares outstanding, as that seems to be in the range of comps and would not introduce too much volatility. Doing a reverse split would also nearly guarantee that institutional investors who cannot currently invest in Athersys due to having a $5 per share minimum or some other requirement of that nature would now be able to do so. I know for a fact that this current limitation has some effect on Athersys stock price because I had attended the 2019 shareholder meeting and talked to an institutional investor at a well-known firm that, quote, doesn't allow him to invest in penny stocks. So he told me that he was just there for his personal account. At the time, he said to me that it was likely that the stock was going to triple or quadruple over the next 12 to 18 months, i.e. he was interested in investing but was unable to invest through his fund, which would certainly have more capital to invest than just him. Furthermore, as the Google search that I read earlier indicated, the more that these institutions invest as long-term investors, the lower the float continues to go, making price appreciation even easier. That means that this reverse split will increase volatility in the stock, but it should be primarily favorable if everything else within the fundamentals of the company are solid. I would ask you to remove your preconceived notions of what a reverse stock split normally implies, as it can be done in a position of strength if announced post-positive treasury results. So when should the reverse split take place? I believe one chronological order that could make sense is first to release treasury results, then to do a small secondary offering to guarantee a certain level of funds, then following that, do the reverse stock split. This timing makes sense chronologically because it indicates to the market that the company is doing it in a position of strength rather than weakness, typically associated with a reverse stock split. Doing it after treasure also removes the risk of doing a reverse split before data, which would potentially cause a highly erratic drop if data is poor, which is what we saw with Cortexon today. And if it so happens that float turns out to not be a problem, indicated by a sustained, reasonable stock price, then the company can choose not to employ it if they deem it unnecessary. But if they choose to do the reverse split, then the company could then raise another secondary at a higher valuation, as it may trigger a valuation increase for reasons that I stated earlier. This chronological order could be adjusted by removing either the first or second secondary offering and just doing a single one. Or it could be also modified upon receiving upfront money from a partnership. Whether it was intentional or not, it was conservative and ultimately advantageous to have so many shares outstanding up until this point to raise capital consistently prior to commercialization. But now that commercialization is upon the company, they should seek to optimize the supply and demand balance, as the company can clearly justify a high valuation upon positive treasury results and therefore realize significant shareholder value. Athersys has had an at-the-market financing facility agreement in place with Aspire Capital since 2011. This agreement allows for flexible financing for the company, which includes raising capital on a daily basis if necessary. I want to draw your attention to all of the similar agreements that Aspire has set up with other companies and the annualized return for each of these companies, which is the column highlighted in red. The top picture shows the annualized returns for companies that Aspire has had an agreement with for greater than 5 years, and the bottom picture shows the annualized returns of companies that Aspire has had an agreement with for less than 5 years. These returns are as of March 27th, 2021, so this is slightly outdated, but is still relevant in my opinion. Because it is small text, it may be hard for you to read, so I'll go through and read the returns starting from the top. -5%, -42%, -32%, 2%, 12%, -16%, -47%, -78%, -57%, 0%, 1%, -36%, -50%, -13%, -14%, -30%, 1%, -38%, -33%, -33%, -51%, -46%, -62%, -65%, -52%, -75%, 40%, -6%, -38%, -28%. And now I'm going to read the annualized returns of the companies that Aspire has had an agreement with for less than 5 years. -13%, -55%, -62%, -15%, -33%, -59%, -4%, 54%, 103%, -54%, -44%, -18%, 9%, -42%, -62%, 35%, -4%, -6%, -23%, -54%, -54%, 54%, 151%, 68%, 733%, -20%, 60%, 96%, and -58%. From reading Athersys' 10 Qs, it appears that Aspire receives a purchase order from Athersys for shares at some sort of discount from the market price, and I gather that they almost instantly sell the shares on the open market for a profit. I feel comfortable making this statement as one would think that Aspire would not want to continue setting up these agreements as long-term returns have been so poor, yet they continue to do so. Therefore, they are likely instantly selling shares on the open market. The problem with this is that it creates a sort of self-fulfilling prophecy where shares are being sold at low levels because Aspire is not incentivized to hold long-term, and therefore Athersys receives capital at low valuations, and therefore they don't have as much capital to work with, which makes operating more difficult, hurting the fundamentals of the company, which makes raising capital at high valuations in the future harder, and so on. I consider this agreement with Aspire to have misaligned incentives relative to other shareholders, and this agreement may be more harmful to shareholders than something like a secondary offering or a financing with a long-term investor. Even if a long-term investor receives shares at a larger discount, there will be less constant selling pressure at these low valuations. So let's revisit the market forces and discuss how they can be improved relating to ATHX stock. Intentions and incentives of the investors. This could potentially be improved upon via decreased use of the ATM facility and a higher reliance on secondary offerings and financings with long-term investors or partners. Capital available to investors. This could be improved in a roundabout way, where the combination of treasury results and a reverse stock split would allow for a new group of investors to invest that otherwise were prohibited from investing in stocks less than $5 or some restriction of that nature. The risk tolerance force may actually become less favorable due to the increased volatility introduced when doing the reverse split. Interest rates are a macro factor that is part of the market, but none of us are in a position to adjust. PR reach/publicity should be improved upon announcing positive Phase 3 results, as that moves Athersys into the small category of companies that have announced positive Phase 3 data. News of entering into a global partnership with a major pharmaceutical company can also increase PR reach and be a source of credibility. Perceived earnings potential can be improved upon via undeniably positive Phase 3 results, PMDA approval for ARDS and stroke, and advantageous partnerships. Perceived risk can be improved by the same factors as the previous force, as well as employing continuously good management decisions and execution. And the float can be improved via the reverse stock split. The combination of these improvements should adjust the valuation of Athersys in a way that more closely aligns with the true value of the platform, product, and company, which I believe can justify a valuation in the many billions of dollars upon positive treasure data. I think the main takeaway here is that a lot of people see value in this company already, and to post positive treasury results, more people should see that value. But because the stock is not a scarce resource right now, it is hard to realize a fair valuation. If you guys recognize any other market forces, let me know in the comments, as it's possible I'm not considering some. Here are my sources and email if you'd like to reach me. Let me know what you guys think of the presentation. I will be sending it to as many members of management and the board of directors as I can find contact info for, not out of passive aggressiveness, but more so to ensure that they have a clear understanding of these forces and are making the best informed decisions for shareholders as possible. Thank you for listening and have a good rest of your day.